I believe the same principles will still be valid in 20 years as they were in 1950, 2005, and now. First and foremost, you need to be aware of the assets you own, whether they are stocks or mutual funds. You also need to have a justification for your holdings, and you should be able to explain this to an 11-year-old in no more than 2 minutes. I tried that one, but there's no solid reason why it didn't work. Basically, you have 3 options today, and if you're an investor, I believe you can put your money in a money market fund to earn 17, 5, and 6% with a 40% tax rate. Bring in a 10-year treasury and receive 4 sevens that are taxed at a 40% rate. Or you can invest in stocks, because I believe stocks will do far better over the next 10 years than 4 sevens or 1 sevens. Now that I would have part of my money, it is up to the individual to decide how much they want to invest in the stock market. For some, 10% is too aggressive, while for others, 50% is the ideal amount. It's a personal choice, and you can't follow the rules that say you should be 100 when you're 25, 50 when you're 45, and 0 when you're 60. I find those restrictions to be pitiful, and I detest them. Why do you feel assured? In 10 years, stock prices will be significantly higher. In any case, stocks aren't lottery tickets. Rather, they're shares in a firm. And since I believe that businesses can generate a lot more money in 10 or 20 years, that's why prices rise. That is the only factor at play in why some businesses fail. The amount of money that Xerox makes today is significantly less than it was 30 years ago. Stocks increase because firms are making much more money than they were previously. Since World War II, corporate profits have increased 40 times, and the stock market has increased 40 times. What are the most glaring errors you've observed investors making? Well, I believe my error was not looking at the balance sheet. You should do the same with a firm. If you look at a person's balance sheet, you can see what assets they own, such as their homes and cars, as well as what debt they have. Let's imagine we are comparing 2 businesses. They're both losing a few $1,000,000 apiece and are in a very sad state at $4 a share. One company has $100 million in cash and no debt, whilst the other has neither cash nor debt. The second company is going to go under. If you can do 8th grade math, you can reach anywhere close to 8 and 8 equals 16. If you look at a company's financial situation, it is also impossible for it to go under. You owe no one anything. You probably face the same demand to demonstrate performance results while you were actively managing money. Did that make you want to sell too soon? Sometimes, though, I believe that my biggest errors have been in stock trading, where you can lose up to $100. You make a lot of mistakes because those ones that go up tenfold, like all the 10-baggers, are the ones that cause a good firm to double, triple, and quadruple in value. So a few of my errors have you wondering what inning I'm in this baseball game, and saying things like, oh my god, this stock is too high and I was wrong. I sold Toys R Us way too soon, and when I sold it, the price increased 20-fold. I also did the same thing with Home Depot. When ought one to sell? If you claim that a firm is a sickle and is performing poorly, you should investigate why you purchased its stock. In the case of Walmart, 10 years after they went public, you could have bought the stock and made 500 times your money because they still are only in 15 the United States, and they could ask why they can't go to 17, why they can't go to 19, why they can't go to 23, etc. You wait until things are getting better and they're doing fantastic and then you sell it. But with a growth company, you have to say. You must tell yourself that you have a 10-year tail and a 20-year story in the stock as you travel the country over the next 4 decades. That's what I do with the company, and that's your choice. That's how you sell it. I'll be able to write that down and adhere to it. Even so, you still purchase a business with the intention of helping it develop. If the business is in the textile, electronics, or software industries, you should have a better understanding of what it does, because if it succeeds, the stock will as well, regardless of the state of the market. You would have made a lot of money if the Dow Jones Index was 1,000 or 500 today.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
In the last 30 years, the earnings of these firms have increased significantly. If the market had been $50,000, you would have lost money in Burlington Industries. However, you would have gained a lot of money in McDonald's, Johnson & Johnson, and Gillette. I suppose I suggested that in 1969, and it went from 34 to 2 without any stock splits. These earnings have been poor, but your modesty actually highlights a crucial point. Those with the highest batting averages around the globe. Don't bat 1,000, but I occasionally get furious, especially during bear markets when people remark that something worked well because so-and-so recommended it. How frequently did you think of a clinker? The funny thing about this is that you don't even need to be right 5 out of 10 times to make a double or triple. When you buy a cycle, ask yourself how much you can lose and how much you can make. If you can make a lot, you should be able to counter all those occasions when you lose 20 or 30%. Because these were high-quality companies, you could lose a lot of money in the stock market. Just consider how much money we lost in the AT&T and how much less you lost than Xerox. Do you ever lose faith in yourself? For instance, let's assume you ask yourself, how much can I make because I want to buy a stock? And if I'm correct, I'm going to make a double or triple. I keep phoning the company because I believe that the market will increase every day. You once told me that you spent all of your time looking at businesses and studying them as businesses, and that you didn't spend much time caring about the economy. What are your current thoughts on the economy? I consider the economy the past and the future, which is similar to weather forecasting. I look at the economy backwards to see what's happening, and it appears to be doing very well right now. The housing market, the auto market, the consumer, and other sectors all appear to be doing well. However, if you consider that there have been 9 recessions since World War II, and that the workforce has typically declined by about 2% on average, this current recession's workforce decline would only be about 1%. So far, this recession has been moderate, especially in the technology and telecom sectors, for companies that manufacture fiber optics, but it has been a typical recession, and I would never bet against the American economy. It is strong. You didn't really like the technology group, did you? I've actually begun looking now. I start looking at these things in January and February, so I'm a little early. I've been researching the companies and they're very complex because unlike a group of banks, each of the 1,000 technology companies is a little bit different. Because they are so similar, you must exercise caution. I'm seeking for businesses that are leading their field, are trading close to cash, and are down 95%. Although the Japanese market and economy have been tremendously poor and have had a 12-year recession, there was a significant banking system issue in Japan, which I find to be a really interesting correlation. Our government is lucky that our companies move rapidly and quickly begin decreasing costs. We entered this recession carrying a surplus, which is unusual in our history. In theory, our nation should run surpluses in prosperous times, and deficits in difficult ones. Guess what? It's working, right? That was lacking in Japan, where it has now been a waste of 12 years. I don't think it has everything, and it doesn't even somewhat resemble Japan to me. We're beginning to get close to getting better. Peter Lu asked you about some common investing blunders. And since the average investor used to hold mutual funds for 16 to 17 years before it dropped to less than 2 years, do you believe that's one of the issues? If time runs out, I suppose I'll also need to express my desires. I'd say some people are as aggressive as 50-year-olds, and some people would desire to have foreign funds. It's like a menu at a restaurant. They should peruse it, choose what they like, and stick with it. If one group performs well for 2 or 3 years, the next round of funding should go to the group. that isn't doing as well. Different categories tend to average out to be similar over time. So if you focus on one for 3 years and then say, "Get me out of that," then switch to another and it performs poorly for 3 years, you might stay there indefinitely without ever making money. Does this market, Peter, make you think of any others you've gone through before, say 1990? In many aspects, the 90 bear market is analogous. For example, one may imagine that Saddam Hussein takes over Kuwait. You know, everyone is predicting that when we send 500,000 troops to Saudi Arabia, Iraq will have the third largest army in the world and will become another Vietnam. With all these banks and the current problems, we experienced a recession. That was a really scary environment, and we had defaults. So it was an ugly environment and everyone was terrified. I believe that was a very similar market and that 81-82 was also unpleasant. However, our banks are in excellent form, which is a significant advantage. We experience a 20% prime rate, double-digit inflation, high unemployment, and to top it all off, the 73-74 market. Do you recall the Nifty 50 we had in technology stocks? There were 95 declines in that market, and we combined 3 markets into one unique situation where money was spent quickly. There is less than a minute left. People who are less optimistic about the economy than you just frequently point to recent dollar declines and the switch from a surplus to a deficit. As negatives, you seem to suggest that they are positives. Why? Well, I think the government running a deficit is terrific. That's why it should work. I mean, when they're running a $200 billion surplus, which they were, they're pumping $200 billion into the economy. Now the government's running a $100 billion deficit, it's pumping $100 billion in its cushion, so you don't see a double-dip recession coming. I'm not sure I can change the future, but that's a good thing to have. Buffers in the economy. There have been 2 recessions in our lifetimes, and there have been 9 worldwide. The system works. What piece of advice, if any, would you offer to frighten investors right now? I believe you should watch some young children. Hire an 8-year-old or a 6-year-old and observe them. The yield curve's form is known, and people are hopeful about the future, believing that things will be okay for the next 30 to 40 years. Courage and perseverance have been successful in the past.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.